Okay, so now what we're going to do is break this down into two systematic approaches in Chapter 5. We're going to focus right now on purchase inside of inventory, okay? And we're going to break down each part of the purchase inside of inventory into the categories you need to know how to address. So, rule number one, inventory is always on the books at cost. So whatever you pay for it, keep that in mind, that's what should be the amount representing your inventory, what you paid for it, okay? If you can understand that little small tidbit, everything else moving forward will be much easier, okay? So the first step we're going to talk about is how to purchase inventory, how to make the purchase a journal entry for inventory. And we already know how to purchase inventory. We've been doing that for a while, right? And so let's do it. Let's just open up with some scenarios, right? Let's say, suppose that we bought, let's say, purchase inventory on account 210 net 30 for let's say $10,000. A lot of stuff going on, right? And I'm gonna adjust this so that you can see what we're doing. So suppose that we purchase inventory on account 210 net 30. Let's suppose that the date is May 1st, right? Suppose the date is May 1st. May 1st, whatever the year. Okay? Keywords, inventory was purchased, right? Very much a keyword. On account, right? And 210 net 30, okay? So before we go into the 210 net 30, let's talk about the keywords and do our proper journal entry, right? Two accounts that affected, inventory and account. We made the purchase, so we know inventory is an asset. Asset increase on the debit side, so we're going to debit inventory for $10,000. And we're going to credit what? It's an account, keyword account, two types of account. What account are we referring to? Accounts payable. Liability. And liabilities increase on the credit side. So this is the correct answer for this particular transaction. But let's simultaneously address what 210 net 30 is, because this is very important. 210 net 30 is what we call discount terms. Discount terms. And so I'll give you a couple of other examples of discount terms, and we can explain this accordingly. So I'll give you a few examples. We're going to take the 210 net 30. We're going to say 115 net 45. And let's say 210 EOM. Okay? So these are apparently the following discount term examples, and I could explain them accordingly. So, how do you interpret a discount term? Well, what is a discount term? A discount term is simply a term in which a seller will extend to the buyer to influence them or to entice them to pay on the goods back as soon as possible. Discount terms are always extended through credit. So anytime that you sell something on credit or on account, I hate to use the word credit, on account. So anytime that you sell something on account to somebody, or anytime that you buy something on account, they may have discount terms offered. And all discount terms do is entice the buyer, right, to pay back the amount owed as soon as possible. As a business person, you always want to collect on your accounts as soon as possible It's because of two things. One, it's holding up cash. They're holding up your cash, and you want your cash as quick as possible so you can buy more inventory and generate more revenue. That's the main rule. The other rule is the longer that you wait to collect on your account, the higher chance you have to not collect on your account, thus increasing your uncollectability. And so you want to get your cash as soon as possible. And so that's where these discount terms come into play. And so basically what we're saying is that you will receive a 2% discount on whatever you pay. A 2% discount on whatever you pay, as long as you pay that amount within 10 days of the sale. 2% discount on whatever you pay within 10 days of the sale. Okay? Or you have to pay the net amount, the entire amount within 30 days. Okay? So worst case scenario, you still have to pay everything in 30 days. But you could get a discount if you pay within 10 days of the sale, 2%. 10 days of the sale being the first, but if you could pay by the 11th, right, 10 days after the sale, then you can get a 2% discount. Okay? How would this one be? Same way. 1% discount if you pay within 15 days of the sale. Or you would have to pay what? The entire amount within 45 days. Okay? And last but not least, you get a 2% discount if you pay within 10 days of the sale. Or you have to pay the entire amount at the what? End of the month. Okay? And so that's what discount terms mean. And basically it's just a systematic approach to try to entice people to pay as quick as possible. Okay, so we're the purchaser on this situation. And so we are having the opportunity to receive a discount if we pay within 10 days some of this money that we owe on the payable, the $10,000. All right? So, let's see how we will handle a payment within discount terms. A payment within discount terms. Let's suppose that it is the 5th of May, and suppose that we pay, let's say $4,000 on account. What are the key words? Account and pay, right? We always say when we pay, we have to do what to cash? Credit cash, right? Now we see account, we see pay. Again, what account is affected? Accounts payable. What's happening to our accounts payable? It's going down. So we should debit accounts payable. And we know we should credit what? Cash, because the keyword pay. All right? So, pay close attention. Accounts payable, how much did we try to pay within the discount term? First of all, how do we know we're in the discount term? Because it's 5 days. It's the 5th, right? We actually made this purchase on the 4th. 4 more days happen, right? If you're not considering the first day of the sale, which will bring us to the 5th. And we made a payment. So will we receive a discount? Yes, we will. Why? Because we paid $4,000 within the 10 days of the sale. All right? So our accounts payable is coming off the books at the full amount. Accounts payable always come off the books at the full amount, the $4,000. However, our cash amount shouldn't be $4,000. We paid in the discount terms. So should it actually be $4,000? No, it shouldn't, right? It should actually be $4,000 minus 2%. Now, if you guys have calculators, you should be able to calculate the 2%, but some of you guys' calculators won't do it. So another way to calculate the correct answer would be to take $4,000 and multiply it times 0.98%. 0.98. 0.98. Why? Because roughly that's saying that you're only going to carry forward 98% of that amount that you're paying because you get a 2% discount. Either way, it gets you the right answer. So how much cash did we truly pay out of the $4,000? We truly paid, what is 2%? That's for 80. So we truly paid $3,920, right? 3,920, right? And so our debits and our credits don't equal. So we're not finished. Why are our debits and credits equaling? Because we know that we just received a cash we just received a discount. Okay? And so our cash is not less. So, ideally, let's consider what happened in this situation. We started out paying for inventory for a certain amount, right? But then we wind up receiving a discount of what we paid for originally. So what should happen to the cost of our inventory now that we received a discount? Think about it. Your cost should go down. And what's rule number one? Inventory is always at the books at what? Cost. So if your cost went down because of a discount, then what else should go down? The cost of your inventory. So what should we credit to make sure our debits and credits equal? Inventory. Inventory. And the reason we're crediting inventory for $80 is because of the mere fact that we received a discount or discount on the purchaser side, a purchase discount we received, and it has to lower the cost of our what? Inventory. Very important. Watch this video again so that you can make sure you understand.